Hello, everybody. I'm Jeff Epstein from Bessemer Venture Partners. This is a presentation that I prepared for a class we teach at Stanford's Graduate School of Engineering on startups. And it's based on an old movie, an old Mel Gibson movie called What Women Want. It's a great old comedy where he's in the advertising business and he's trying to figure out how to sell products to women. And to do that, he has to think like a woman. And so if you're trying to persuade investors to invest in your startup, it's very helpful to think the way investors think and understand. Don't tell them about what you're trying to do. Try to figure out what they're trying to do and see how your company fits in with that. So this is the goal of this presentation. There's a lot of slides and a lot of numbers and detail, and we'll get you the slides later. So I'm just going to go over the high points and we can follow up with the details later. Feel free to reach out to me anytime after this call if you have other questions. So let's start and talk about venture capital. Venture capitalists think like a venture capitalist. How do they think? They specialize, and they specialize by risk stage, early stage, mid stage, late stage, by market sector, healthcare, software, hardware, services, and by geography. And at every funding stage, they think about risk and valuation. And at the very earliest stages, you have the highest risk. And then as you get more and more proof points, more and more evidence, the risk goes down and the valuation goes up. And investors specialize. Some people like to invest very early when the valuation is low, but the risk is high. Other people like to specialize later on when the risk is lower, but the valuation is high. And so you have to think about where you are on that spectrum and where the investors are on the spectrum as well. So let's give a sense of the size of the market. Last year in 2020, there were 12,000 venture capital investments in the United States, an average investment of $13 million for $150 billion asset category. So lots of investments. You can see that almost half of the investments were angel and seed stage, about $2 million each. There were 3,500 Series A and B, 12 million each, and Series C and later, over 3,000 investments at about $30 million each. So most of the money is in late stage, 100 billion out of 150 billion, but most of the deals are in the early stage. Now, venture capital famously follows a power law, meaning, and this is some data recently from about all deals over the course of many years, half of all venture investments lose money. Only 6% of the deals produce more than half the return. So imagine playing baseball and you can't, it's not just you get a home run, you get one run, or you get a grand slam, you get 4 runs. When you get a grand slam in venture capital, you can have 100 runs or 1,000 runs. And that's what everyone's playing for. So the venture capital investors don't only want to get their money back, they want to think that from time to time, they're going to make 10 times their money or 50 times their money or 100 times their money. That's what that's what they're looking for. So let's give some examples. First, I'll give you an example of something that's not venture capital, and I'll use Quibi, which was the well-publicized, well-marketed, but poorly performing Quick Bites video that came out last year. They founded in 2018. They raised $1 billion. In 2020, before the product launch, they raised another $750 million. In early 2020, they had their first revenue, and by the end of 2020, they shut the business down. So they raised $1.75 billion before they had their first customer. This is the opposite of venture capital. Let's give an example now of venture capital. DoorDash. DoorDash started out, actually got its first revenue in 2013 before it had raised any venture capital. Then it raised a pre-seed of $120,000 at $2 million pre-money valuation. Later that year, they raised a seed at $2.4 million. A year later, they raised a 17 million Series A at 54 million. Then a year later, a 40 million round, and then a 120 million round. And you can see how they raised 10 rounds of venture capital year after year after year. Altogether, they raised $5.8 billion. The company recently has been trading at $64 billion after its IPO. So this is classic venture capital. At every stage, they raise enough money to get to the next stage. And at a higher valuation if things are going well. So why does venture capital work? Why has this asset class been around for a long time and the whole ecosystem seems to work well? And the answer is this phased approach or gated capital. Venture capital is gated capital. Venture capitalists give founders 1 to 2 years worth of capital, just enough to get to the next gate, And if during that time the founders don't add a lot more value or they don't reduce risk, then VCs will not fund the next round, and founders have to just live on the money they have. They'll either have to cut costs to get to break even, they'll have to sell the company, or in some cases, they have to shut the business down. So that's the way the game is played, and you need to think about that as you go out and try to raise venture capital. So now with that background, let's talk about how you can raise venture capital. First, at the very early stage, when you have the highest risk and you have nothing to show for it, you just start with your story. You believe someone will build this product, it might as well be you. So what do? You build your first prototype. In DoorDash's case, this was a 6-month phase. They built a website, they had text messages, and the 4 founders were the drivers. And the 4 founders did everything, that's all they had. They spent almost no money. The 4 founders went out and got a couple of restaurants, they built the website, they answered the texts, and they delivered the food. They would go to they didn't even sign up the restaurants to participate in the program. They would just order the food as consumers. They'd go pick up the food and they'd take it to someone's house. That's about as minimum viable product as you can get. So what do you need to raise a pre-seed? Fundamentally, you need a team. Generally, in any startup, you need a team, traction, and market. And which of these 3 things is more important depends on the stage. So pre-seed, the most important is the team. You need to show that you can execute. You need to show that you can start to attract people. It's good to have demonstrate that you have an MVP, that the way DoorDash had an MVP, you need to be able to tell a good story. And you do need to be able to say, this can go beyond Palo Alto in DoorDash's case, but this can be a big opportunity. And venture investors want to know that you're ambitious, that you think that you want to build a big company. You don't want to build what's called a lifestyle company that'll just have a few $1 million of revenue. You want to build a company that's going to have the potential for the venture investors to make 10x, 20x, 50x return. So you raise your pre-seed funds. What are you going to do with that money? You actually build your product. So one way to think about it is sometimes if you're building a mobile app, everyone knows you can build a mobile app. But if you're building something complicated, there's product risk. And you're going to want to use that money to prove that you have the technical ability to build the product. And a great example of that is when Genentech started. Their goal was to create insulin using genetic engineering, which is a very hard technical problem. So what was their approach? Genentech said, look, we're not going to give you money to build insulin because that's too much money and too hard. We're going to give you $100,000. Why don't you create somatostatin, which is a protein with only 14 amino acids, which was simpler than insulin's 51 amino acids. If you can build that, then we believe you can build a more complicated product, will give you more money. If you can't get through this gate and you can't even build somatostatin, we're not going to give you the money for insulin. Of course, they were able to build both molecules, they got the money, and they built an incredibly successful company, Genentech. Another example, Airbnb. So lower your risk by running successful experiments, even if you can't do those at scale. So early on, Airbnb knew, based on data, that if their host had high quality photos, conversion increased. But hosts generally were poor photographers and they had poor photos. So what did Airbnb founders do? They flew to New York. They personally took high quality photos of many apartments. Conversion increased. They knew when Airbnb had 1 million photos, they couldn't personally go out, 1 million hosts, they couldn't go out and take photos of every apartment on the site as the founders. But they figured that if they could do this manually at first, over time, they could hire photographers, which is what they did. So they did these non-scalable experiments, which proved that it could work. And a big question to answer is, if you build this product, who is going to care? Paul Graham, the founder of Y Combinator, has said, it's better to have 100 people who love you than 1 million people who like you. And the idea is, if you could find 100 people who love you, you can probably find 101 people who love you, and 102 and 103. So you have something. The whole idea, in Peter Thiel's words, is to get from 0 to 1. Once you have 1, then there's another question of getting from 1 to 1 million or 1 to N. And so from the very early stages of startup, you're trying to build something that didn't exist before, that people love, that people use. And it's hard to build something that 100 people love. But that's what you're trying to do in the very earliest stage. You want to build a product that's so good that users get addicted. So if you were around when Google was first created, and there were many other search engines, AltaVista, Lycos, Excite, Google was so good that everyone started using it right away, even from the very early days. Superhuman. These are some quotes from Superhuman, which is an email software product out today. Superhuman has moved me both physically and emotionally. This tool saved my marriage. The world was void of happiness. Now I can hear color. These are obviously incredible comments from happy users, but this is what you're trying to get. You're trying to get to users who love your product so much, they'll write these kind of comments publicly. You want to be able to measure engagement. So you can do all sorts of charts. If you have, what's your engagement month 1, month 2, month 3, how many people come back? If people go away, do they come back later or do they use more? So there's a lot of metrics you can use, even with no revenue, just on metrics. You want to find other signs of product love. People who say, what you have works for me. Yes, I would love these other features, but I can use the product right now without even changing any of the features. Customers are recommending your product to others without being prompted. And users are finding you based on word of mouth or based on press or other ways without paid advertising. All these are great signs of product love. So let's go back to DoorDash. What did DoorDash look like at the seed stage? This phase lasted about 6 months. They had 20 drivers, 2 customer support people, only in Palo Alto and Menlo Park. Customers loved and restaurants loved and were recommending the product, and some users were coming back several times a week. They still only had 4 founders with 2 people doing customer support. They'd only spent $150,000. So here, now you've raised your pre-seed, now you're getting ready to raise a seed. Now traction becomes important. You need to demonstrate that you have fanatic users. In an ideal sense, you have a few customers. Doesn't have to be a lot, just a few customers that love your product. You don't really have to have much revenue. You have to have plans to be able to reach $1 or $2 million of annual revenue in some period of time. You need to have a few key people, a minimum viable team, and you need, again, to be ambitious and show that you have a big opportunity. So now you're ready to raise seed funds, and what are you going to do with that money? You're going to raise seed funds in order to acquire your paying customers and prove you have product market fit. What is proof of product market fit? Well, these are some rules of thumb. There's no black and white answer, but here are some things that I think about in my own mind. If you're a B2B product, if you have 10 paying referenceable customers, I believe you have product market fit. You'll be able to find an 11th and a 12th. If you're consumer is easier to get, but consumers are less loyal, so you need more consumer paid customers. In that case, I'd say you need 1,000 paying referenceable consumer customers. If it's free, you need many more customers, because if you're free, you need to be supported by advertising, and advertisers need big audiences. So for a consumer free product, you need to have 100,000 monthly active users. And again, these are just rules of thumb. Another way to measure product market fit is through the Superhuman user survey. You ask these 4 questions. You need to have a minimum sample size of 100 users. How would you feel if you could no longer use our product? Very disappointed, somewhat disappointed, not disappointed, or I no longer use it. And if 40% answer very disappointed, you can say you have product market fit. If you're at 20%, that's fine. What you do is you say, well, let's find who are the 20% who would feel very disappointed. How do I find more of those? Maybe you don't have enough of the ideal customers, and you need to focus on a narrower segment where they find great value in your product. And then if you build up that segment, and if 40% of them say they'd be very disappointed, then you have product market fit in that segment. Another key metric is Net Promoter Score. This is very well known, and you can look it up on Wikipedia. You want to get a Net Promoter Score above 50. That would be another key metric for product market fit. For mobile apps, and the different segments, different types of products have different metrics. For mobile apps, you could say that 90-day retention is a key metric. You want to have after 90 days, you want 60% of the people who downloaded your app to still be using it. If it's above that, you've got a pretty good metric of product market fit. Another metric is, if you're in the software business, what is your growth quality quick ratio, which is defined as how much monthly recurring revenue have you added compared to how much monthly recurring revenue have you lost, and you want that to be above 4. Of course, not every company will have all of these metrics. These are just examples of kinds of things that you want to measure internally, and if they're working, you want to share those with potential investors. So what did DoorDash look like at the Series A stage? This stage lasted about 9 months. Palo Alto was growing. They expanded to their second region, San Jose. The metrics were looking similar to Palo Alto. They were up to 20 full-time people. They had 300 drivers, and they had spent $2.3 million. So what do you need to raise your Series A? Now the market size becomes important. You need to convince your Series A investors, if they're institutional venture capital investors, that this company can be worth over $1 billion. Not that it's going to be worth over $1 billion. Remember, 60% of businesses fail that are venture backed, but the potential, they want to believe that at least some of, if I'm a venture investor and I have 10 portfolio companies, I want to believe that at least one or two are going to be worth over $1 billion. I want to demonstrate that I have a growth engine. I want to have some traction with ARR, some metrics on churn. I want to plan that I'm going to grow 3 to 5x over the next year, because I have to grow quickly in order to get to that $1 billion. And I have a core product team and some initial traction with a growth or a sales team. So I then raise my Series A funds in order to prove my revenue model. What does that mean? Well, if in B2B, I need to have some metrics on my effectiveness of my go-to-market approach. And what we use at Bessemer is, what is my customer acquisition cost and how long does it take to pay that back, even without paying for R&D or G&A, just paying back my sales and marketing. If I can pay that back in less than 2 years, that's a good threshold, ideally 18 months. Also, if I have salespeople, are more than half or 75% of my salespeople achieving quota. In consumer, because consumer lifetime value is different than B2B lifetime value, I have to have a different, more stringent metric. And that metric we look at is, I want to have double my CAC payback in less than 18 months. So if I spend $1 million on customer acquisition cost, I want to get $2 million back in less than 18 months. Also, I need to, at some point now, when I'm thinking about Series A, to show that I have some scale. I like to see that I have annual gross profit of greater than $5 million at this phase. And the reason is, remember, my investors, thinking about what investors want to have a unicorn. They want to have a unicorn worth over $1 billion. How do you get to $1 billion? In normal years, you have to have about 100 million of annual gross profit. These days, valuations are even higher. So maybe you can get $1 billion on less than 100 million of gross profit, but let's use that as a sort of metric over the cycle. And they don't want to take 20 years to get to 100 million. Investors want to get to 100 million of annual gross profit by, let's say, the 6th, 7th, 8th year of the company's life. When I say, how do you measure annual gross profit? Well, for cloud software, it's how many customers, what's your revenue per customer, and what's your gross margin. For a marketplace, how many buyers, how many transactions per buyer per year, what's your revenue per transaction, what's your gross margin. So it's pretty easy on a single sheet of paper to measure what you think you might be able to generate in years 6, 7, 8, whatever your business model is. And then you say, well, how do I get from here to there? And the answer is, you have to go pretty fast in the early years. You have to grow over 100%, or else you're not going to get there in a reasonable period of time. Because why over 100%? Well, remember, we're trying to get to 100 million of gross profit in year 6, 7, or 8. And the way to do that is triple, triple, double, double, double. So let's say it takes you 3 years to get from startup to 2 million of revenue. If you can then triple revenue in 1 year from 2 to 6, and then you can triple a revenue again from 6 to 18 million, and then double the next year, double the next year, and double the next year, that means that in 5 years, you've gone from 2 million to 100 million plus, which is 8 years from the time you founded the company. So that's what venture investors really want to believe you can do. Of course, not many companies do it, but the best companies do that. And you can look at these charts. Not only can they do it, they're doing it increasingly quickly. So if you go back and you look at Cornerstone, which is a cloud software company that is sort of earlier generation, they took 12 years to get from 1 million to 100 million of revenue. Coupa took 8 years, Shopify took 6 years, Twilio took 5 years, and then HashiCorp, Slack, and UiPath were even fast. So these are the companies all venture investors want to invest in. And of course, not every company is going to be this successful, but when a venture investor invests in a Series A company, they want to believe that you have the potential to have these kind of outcomes. That's what they're looking for. What other kind of metrics are people looking for? Well, we talked about growth, 100% plus, sometimes even 200% plus, CAC payback, low churn. They want to see net negative churn, meaning if you start with $1 million of revenue at the beginning of the year with no new customers, you end up with more than $1 million, more than 100% net renewal rate. And they want to see cash flow efficiency, that a dollar of cash burn generates more than a dollar of ARR. For consumer, there are comparable metrics. What's your resting growth rate? What's your lifetime value to CAC? And how many potential customers do you have? How big is the market? So that's Series A. Let's go on to Series B. You want to raise your Series B funds to prove, you've already proven product market fit. You've already proven your sales and go-to-market model. Now you want to prove your net renewal model. You want to prove that your customers come back. And you want to have a net renewal rate above 100%. Which means, yes, you're going to have some customers cancel, but the existing customers will buy more. So you'll end up at the end of the year with more than 100% of revenue, of starting revenue from the existing customers with no new customers. You also want to prove you can grow at low incremental cost. This isn't true for everybody. Obviously, Amazon has low gross margins, but generally, if you have a higher gross margin, you can invest more in sales and marketing, and that's a good thing. So many investors focus on only high gross margin companies, not necessarily companies that have a high gross margin today, but companies where the business model is that you can have high gross margin over time. So investors will specialize based on whether or not they focus on high gross margin products. Another key metric is the efficiency score, which is a measure of growth and profitability in one metric. If you add the growth rate, your revenue growth rate plus your free cash flow margin, many investors want to see that above 40. Most companies, when they go public through an IPO, are above 40 at the time of the IPO. They're above 50 or 60 or 70 a few years before the IPO. Over time, after they're public, their growth rate slows down, so they might end up with a lower efficiency score. But this idea of an efficiency score above 40 is a key metric for many investors. Cash burn, what we call a cash conversion score, is very important. We want to see that you're growing quickly while burning a small amount of capital. And there's two different metrics of how to look at that. Because we want low risk, we'd love for you to have your entire leadership team in place. They've been working together for 12 months. Things are going fine. If you have gaps in your leadership team, that creates risk for the investor. We'd like to see that you have diversified suppliers and diversified customers. No customer, partner, or supplier accounts for more than 1% of revenue. If you're not diversified, that creates risk for the investor. What are some other factors? Well, why now? If you have a good explanation of why your company was started now and not 5 years ago or 5 years from now, that creates a very valuable, it creates a lot of coherence in why this is a perfect time to start your company. Uber has a great why now story. Uber could not exist without both passengers and drivers having smartphones. And in fact, Uber and DoorDash started soon after everybody got smartphones. Why you? You are the perfect person to lead this company. As an example, Mark Benioff was a sales executive at Oracle. He was dissatisfied with the tools he had available. He built Salesforce for salespeople like him. Show you have a technical advantage over alternatives. As I said before, there were many search engines before Google. Google came out with an innovative way of using PageRank algorithms to deliver superior search results. Competitors weren't able to copy that, at least initially, and Google's search results were better than the alternatives. Show you have an economic advantage. Amazon famously required all their employees they didn't buy them desks in their offices. They required them to buy doors at Home Depot and build their own desk to prove how low cost they can be. They were obsessed with low costs and building their business, taking advantage of other people's high margins. Network effects, extremely important. Once again, with Uber, the more drivers you have, the faster you can have a car show up for a passenger. The more passengers you have, the more revenue, the more income the driver can make. So if you are lucky enough to have a business with network effects, that's a very important factor for many investors. So we talked about a lot of key metrics. This is a summary slide of some 11 key metrics. And once again, these are all rules of thumb. No company is likely to have all 11 of these, but if you have several of them, or if you have many of them, you're likely to be, well, in summary, if you have many of these key metrics, call me. Bessemer is very interested in investing in your company. So these are kinds of things investors would like to see. So you've started your company, you're at the seed stage or pre-seed or Series A, you're now looking to reach out to investors. What's the best way to reach venture investors? And think about this. The answer is not have an investor introduce you to another investor. And the reason is the new investor is going to say to the first one, well, did you invest? And if the first one said, no, I didn't invest, I passed, they're going to say, so you're sending me your rejects, right? And that creates a difficult conversation. The venture capital customer, the key customer of the venture capital firm is the CEO of their existing portfolio companies. So the best way to reach venture investors is to research them, find investors who have specialized already in your stage, sector, and geography, get to know one of their portfolio company CEOs, and then ask the portfolio company CEO to introduce you to that partner at that venture firm. Because the venture investor is going to take a lot of trouble to make sure that their CEO is happy, and if they get a high quality introduction from one of their portfolio company CEOs, they're going to take it very seriously. So that's a quick overview of what investors want. We went through a lot of detail, and now I'd be happy to take questions. Okay, looks like there's a question. Rachel, are we going to take questions by text, by chat, or by letting people ask questions by voice? Maybe by chat. So I have one question in chat. In a pre-seed phase, by an ability to attract people, do you mean attracting customers or extending the team? I mean attract people. So the founders of the company are always persuading people. They're persuading customers to try the product, buy the product. They're persuading people to join this high-risk company. They are persuading investors to invest in the company. They have to have this vision. If you're a brilliant technical founder, but you can't persuade people to join your team, you're going to have trouble building a company. You know, these companies start out with 2 employees or 4 employees. If you have a $1 billion company, you're going to have 1,000 employees. How can you build a 1,000 employee company if you can't persuade people to join you? And so the ability for those founders to persuade people to join the team when it's high risk and they're going to leave their high paying, attractive job at Google or some other company to join your risky startup. If you can't do that, that's a problem. If you can do it, it's proof that you're on your way. Okay, let's see. A warm introduction from one of your current investors is a good introduction. Yes, as opposed to investors who did not invest in you. If I'm a partner, I'm an operating partner at Bessemer, not an investing partner. But if my colleagues who are investing partners get a call from a partner at another firm, and they say, like, you know, Joe is a great guy or Sally is a great founder and she has this terrific company, you should meet her, but I personally didn't invest and my fund didn't invest. You know, the first question is, well, why didn't you invest and why are you sending it to me? Your firm is in the same business. So it's not saying it's a terrible, if you have no other alternative, you should obviously try to get a warm introduction, but you're going to have to overcome the bias that, well, you're sending me your rejects. And that is much better to get an introduction from someone who is investing or has invested, or someone who maybe is not an investor, but is a mutual friend. And certainly the best investments come from the CEOs of the portfolio companies of the investor. Okay, let's see. I'm reading it looks like there's 2 different, there's chat and there's Q&A. So I'm going to try to read both of these. Assembly Drop is building the B2B marketplace for construction materials. Do I suggest a bottom-up approach on the market side, a market slide? What metrics would I recommend on the go-to-market strategy side? Well, first of all, I'd love to hear about your company. So send me an email at jeff@bvp.com. The challenge any marketplace has is the cold start problem or chicken and egg problem. How do you find buyers if you have no sellers? How do you find sellers if you have no buyers? And what DoorDash did is DoorDash they did not find the sellers. They just called they just went to restaurants and said, I'm going to buy food from you. I'm not asking you to sign up for DoorDash. I'm just going to pay you money. And so they cold started the problem by finding the buyers of the food online by having a website and telling their friends and ultimately advertising online. And then they only recruited the restaurants after they already were customers of the restaurant, after they already were buying the restaurants. And that's typically the case. It's usually easier to get people to join your marketplace if you're paying them, and it's harder to get people to join if they're paying you. So the harder side of DoorDash initially was finding the people who are buying the food, and the easier part was finding the restaurants, because they were paying the restaurants. And I don't know enough about the concrete business and the construction material market, but that's the challenge as well. Another way to do it is by having a directory to attract the buyers, and then once you have the buyers, then you convert the directory into a marketplace. Okay, let's see. What pitching tips do you have for founders raising pre-seed for a consumer product before the product launch? I don't have experience in that. If you have no users, you're basically you're gonna have to try to persuade people on faith. And then I would imagine that if you have a track record, if you have already launched consumer products and now you're launching another one, people will bet on the founder as opposed to betting on the product. If you have a product where you have research that shows people want it, or maybe they bought a similar product and yours is better or cheaper, you can say, look, there's a huge market for this, but ours is better and it's a lower cost. Therefore, we have some evidence. Fundamentally, you're trying to reduce the risk to the investor, and some investors are willing to take the risk and some investors aren't. And I would go back to what I said earlier, that if someone has never invested in a pre-launch consumer product, the chances are they're not going to invest in your company. But if they've invested in other pre-launch consumer products, then they're probably looking for pre-launch consumer products, and they're a very good target for you as a potential venture investor. Let's see, I'm going to answer this online. I'm going to put my email in for people who wanted to know my email. Let's see. How do you take a decision at the investment committee in venture capital? Is it a voting? Is it consensus? Does one partner say they're committed? Every venture firm is different. So some venture firms, the individual partner has the unilateral authority to say, I'm going to commit capital. Some venture firms have a vote. Some venture firms have a majority vote. Some venture firms have the leading one or two partners have a veto, and they can cancel it. They can veto everybody else. Some venture firms, at Bessemer, we have this model where the senior partners can make investments. The junior partners are paired with a senior partner. And so the people who just were promoted to partner work closely with a senior partner, and usually together the two of them can decide on something. Although we fundamentally believe in conviction. We believe that if we trust you enough to be a partner and you're willing to commit your reputation, you have the ability to commit capital, which I think is the more common type of structure for venture firms. But I've heard of stories where a founder had a commitment from a partner at a firm, and then they went to a partner meeting and the other partners vetoed it, and because the partner didn't have enough pull in the firm, and the founder had stopped their fundraising process, and it created problems. And so, I guess if you are the founder, I would wait till you actually get a term sheet in writing from the firm before stopping your process. And you should ask, what percentage of the time have venture firms given term sheets and not funded? Some firms it's virtually 100% probability you'll close on a term sheet, and other firms it's not. So you need to understand how much risk there is even after you get a term sheet. Okay, let's see. How often is convertible preferred stock used in earlier deals? And there are fundamentally two ways of doing early stage venture deals. One is convertible preferred stock where you price around. You say, I'm investing 2 million at 10 million pre-money. So you're buying convertible stock, you're buying preferred stock, which is convertible into the company at a $10 million valuation later on. The convertible part of it and the preferred part of it means if the company fails and sells for $2 million, I get my $2 million back before anyone gets anything. So it's a way to protect the downside. The convertible part means it converts into common equity, so I get the upside. So that's the most common part of a venture capital investment. There's another alternative called a SAFE, which is a convertible loan, and that is typically unpriced, or it's unpriced with a cap, and that is less expensive because legally there's lower legal fees, and it's simpler and quicker. So sometimes people do a seed. Y Combinator famously recommends doing a SAFE, and then you'd have a price round in your next round, and the SAFEs would all convert into convertible preferred. Yes, the slides will be available. Someone asked about the slides. They will be accessible. I'll make them available to Icon, and they'll figure out how to distribute them. Do we look at the same metrics when it comes to deep tech startups? No, I think deep tech startups are somewhat different. There's two fundamental kinds of risk for any kind of startup. One is market risk, meaning if I build it, will people want to pay a reasonable price for it? The other is, can I build it? So for instance, if I was building Airbnb, you could say, yeah, I know I can build a website that people will put their, if people are interested, they'll be able to make bookings and put their apartments and homes on it. The question is, will anyone stay in a stranger's house or a stranger's apartment? So there was real market risk for Airbnb in the early days, but there really wasn't much product risk. Everyone knew you could build a website, a travel website. But if you're curing cancer, there's no market risk. You know, if you come up with a cure of cancer, there's going to be an enormous market for it, but there's huge product risk. It's hard to cure cancer, and people would be skeptical that you have figured out a way to cure cancer. So when you have a deep tech startup, the fundamental question is not, will people buy it? The question is, can you build it? And so that goes back to the Genentech example of, if you have a technical team that has experience in human genomics, if you can demonstrate you could build a smaller, easier to build molecule, that lowers the risk, and that opened up the key for Kleiner Perkins to invest in a later round of Genentech. Let's see, next question. Early stage enterprise SaaS startup, acquiring partners who in turn can deliver customers versus acquiring customers, which is better to validate traction? Let's see. In my experience, many successful cloud software companies use both models. They both sell direct and they sell through partners. For instance, I served on the board of Intact, which competes with NetSuite. It's software for finance teams, and they sold through small accounting firms, and about 40% of their revenues were through their accounting firm partners, and 60% were direct. Now, when you're starting out and you're getting your very first customers, those partners would probably say, I'm not going to waste my time trying to sell your product because you don't have any customers. Who knows whether it works? Why would I invest all the time to get trained? Why would I risk my customer relationships telling my customers about your product if I don't know it works? So the very early stages, my experience is partners will not want to work with you because the partners will say it's too risky. They don't want to invest the time. They don't want to risk their customer relationships on an unproven product. So the very first products have to be direct. Often the very first products are sold by the founder or one of the co-founders. And then once you get a certain critical mass of referenceable customers, and whether that's 10 or 50 or 100, depends on the business, at some point you can go to a partner, and you probably don't want to go to the biggest partners. You don't go to Accenture and say, look, I've got this little company with 100 customers. You should be our partner, because Accenture wants $100 million revenue streams. They don't want $100,000 revenue streams. But there's probably some hungry partner out there. In Intact's case, it might be an individual who has an individual accounting firm, or a 5-person accounting firm, and one person at that firm is focused on technology. And that one person, and the Intact deal was, we're going to give you, I think it was 30% of revenue every year forever for every customer you bring in. So if you bring in a $20,000 a year customer, you'll personally make $6,000 a year for as long as this customer stays a customer. So initially, if you're an individual working for the small accounting firm and you can sign up a couple of dozen customers and you make a couple $100,000 personally, that's great. And then next year you make $200,000 for nothing just by renewing the people you already had. So, if you think at that level for these individuals at these very small partners, it's actually a pretty meaningful income. And then if you can sign up 5, 10, 20, 50 partners like that, you can build a nice business in your early stages for a cloud software company. Next question, how should a founder measure progress during the fundraising process? Well, the goal of the fundraising process is to get two bidders to compete with each other. The value of your company, the value of any sale, if you're selling your company, for instance, is the value the second highest bidder places on your company. Because if you have two bidders who are willing to pay something, you can go back to the highest bidder and say, or the second highest bidder and say, you just lost, you have to pay more to become the highest bidder. So if you have two venture firms and you like them both equally, and one of them is valuing your company at 10 million and one's valuing it at 12 million, you go to the one that's valuing it at 10 million and say, you've lost unless you raise your bid. And then you can just keep on doing that until somebody drops out. So the goal is to get the highest possible bid from the second highest bidder. In order to do that, you want those bids to come in simultaneously. You don't want to get a term sheet from a company, from one firm today and another one a month from now, because the term sheet will have a 3 or 4 day or 7 day time limit on it, and they're not going to wait around for you typically. So you want to run your process. So ideally you have you might go out to 10 or 15 firms, and you try to get 4 or 5 who are interested, and you try to get, let's say 3 or 4 term sheets, ideally at least 2 term sheets where you then can have some leverage when you negotiate with people. So that's how to measure progress. Are you getting your initial meeting? Are you getting your second meeting? Are you being invited to the Monday partner meetings to present to the partners? And ultimately, are they showing interest? Are they returning your calls quickly? Have they asked a lot of detailed questions? And have they told you their timeline about when they're going to likely to give you a term sheet if they're interested in that? Okay, let's see. What are the insights about common traits across successful founders and entrepreneurs? The single most important common trait is determination. It's very hard to start a company. I've never done it. And as you know, most companies that are started fail. And so if you read stories or talk to people who founded companies, there are a couple of companies like Google that seem to be successful from the first day. But most companies went through struggles. There's a great book about the founding of Intuit, where I think they might have gotten up to 20 or 30 employees. They were selling their product, Quicken, which was their first product. It was doing pretty well. And then the market changed. They struggled. They had to lay off everybody. They went down to only the 2 co-founders. They didn't take salaries for 6 months. And of course, they almost shut down, but they didn't quit. And they just kept on working at it. And they finally got some traction and got revenue and started hiring people again. And of course, now it's a huge multi-billion-dollar business. But it came very close to literally failing. And so I probably would have quit. I mean, it's a rational thing for someone when you're down from 30 people to 2 people and you can't pay yourself to say, look, it's not working. We tried. It was a good effort. Let's quit. And founders are irrational. They don't quit. They believe fundamentally this product should exist. They believe they're changing the world. And as an investor, what most investors look for is that irrational quality of people who will just not quit. Let's see. What do VCs look for when recruiting for their firm? There's no one model. Some companies look for former CEOs or former founders. Some companies look for former product managers from firms with sector expertise. Some firms look for young people who've just demonstrated they're really talented and capable, and they'll train them. Bessemer has a training approach where we typically hire people in their 20s and early 30s and give them increasing responsibility. And most of our partners joined early and were promoted to be partners. Other firms like to hire people from outside as partners who had distinguished careers. the best thing to do is just look at different firms and look at their LinkedIn profiles and their bios and see the kinds of backgrounds they had. Famously, Mike Morris at Sequoia was a reporter for Time Magazine before he was a venture investor. So there's really no one background. Let's see. Can I shed some color as to what investors are looking for in later stages, and what are the metrics looking up to an IPO? Well, I had that. If you go back and look at the presentation when you get the copy of the presentation, many of those metrics about net renewal rate, efficiency score, cash conversion score, customer concentration, those are all the later stage metrics. So we're fundamentally looking for those, and we're also then trying to look for market size. Do we believe that you have a very large market with your current product, or at that point you can build a very nice, let's say $50 million revenue business, but it may not be able to grow to 200 million in the country, in the product line you're in. You may have to expand to other countries. You may have to add a second or third product. So do we believe either that the market for the first product is big enough, or do we believe you can create a product suite and add products as well? Let's see, healthcare, pharma, digital health is different than the statistics model. What are the key elements from those things? Well, certainly software healthcare is very similar to this. Pharma, if you're talking about inventing new drugs, those are completely different, and I don't have any experience in that. So I think that's we'll have to find someone else who could tell you what investors want in drug discovery. Healthcare, in terms of healthcare services, I think there's probably much overlap in here, because you do have product market fit questions, you have go-to-market questions. What are your customer acquisition costs? What are your net renewal rates in healthcare services? Of course, you have much more complexity and regulation. You have certainly if you have to get FDA approval for something, that's really important. If you have compliance questions, maybe you have just lower overall CAC payback because there's much more friction in regulated businesses. So that it's the same idea, but the hurdle rate is lower, meaning a good CAC payback is not 18 months. A good CAC payback might be 3 years in healthcare, and I don't know enough about that area to look at them. Which of our investments were more successful, deep tech or non-deep tech? Well, my personal investments, let's see, are we still live? Yes, good, okay, for some reason the screen changed. What are my the best investments for me have been boards that I've joined. I joined the board of Booking Holdings when it was Priceline. It had a $1 billion market value. It was already public, and it grew to $80 billion. So anyone could have bought Priceline stock back in 2003 and made an 80x return. And of course, that's not deep tech. That was just terrific execution in a large market. Fundamentally, you had this enormous shift of travel, consumer travel, moving from the offline world to the online world. And Priceline and Booking.com, which is Priceline's biggest business, Booking Holdings' biggest business, became the best in the world at online advertising and converting people from lookers to bookers. I serve on the board of Twilio, which is now today a $70 billion market cap company. They have very exciting technology. It's not deep tech like quantum computing deep tech or curing cancer, but it is hard, and they have thousands of engineers, and they're very good at it. But I think their insight early on was that you could make APIs for telecommunications and fundamentally take a business which was a hardware-based business, telecommunications, and do many of the things that people were doing in hardware, instead doing them in software. And so I think it was, I would say, medium tech as opposed to deep tech. How do I view a company that is an asset carve out from another company? And is there a way to overcome the legacy overhang? I don't have experience with that. I think that's a great area of focus. If you have one of those, I'd like to learn more about it, because the word that I use is orphan. In a very big company, they have hundreds of different products and teams and things like that, and they're focusing on a few things. And it's very easy to have small businesses within a big business where the small businesses are orphaned. They're not getting the resources, they're not getting the focus, and yet there's huge potential. And often those businesses will thrive when they're taken out of the big company context and when they move into another company. And I think a great example of that is when PayPal was separated from eBay. PayPal is now bigger than eBay, and it became a pure play focused company just on financial transactions. And I think PayPal is a better company and a more successful company today than it was when it was part of eBay. And if you have one of those, we'd love to hear about it. And I think there's a lot of potential there. Question, for a B2B to C startup, what does the venture capital company want to see? Is it different from B2B? Well, yeah, there's now 2 levels of difficulty. So for a B2B to C, you have to sell first to the business, which then sells to the consumer. And so as an example, we have a company called Guild Education, which sells education, it sells training to the HR departments at big companies, who are then selling to their employees, signing up for a training program. And so they both have to persuade the HR department at the big company that this is a good thing, and then they have to persuade the employees to sign up for the education program. And they have to, it's just a higher level of difficulty, because they have to have, the answer has to be yes and yes, not just if only one says yes, you still don't have a successful outcome. On the other hand, if you can get the employer, in this case, the partner, the middle B, to say yes, then it's a fantastic distribution channel to consumer. You don't have to pay for consumer marketing, you have built-in marketing. So it's a very powerful channel to go B2B to C when it works. For the venture investor, you have to have product market fit in both. You have to have product market fit both in the B2B side and the second B2C side. Question, the Medici effect, the incentive founders have to solve a problem. What's your perspective about founders that come from a different domain expertise, and how important is founder market fit? I think founder market fit is very important, but not necessarily in the way that sometimes people think. Often the best founders are outsiders of the industry who nevertheless understand the industry. So the Airbnb founders had never run a travel company or a hotel before, but they were fundamentally hosts and guests. They had the sense of what the host and guest wanted. So, and they were creating a new way of bringing a community to travel. And they were bringing the personal experience as opposed to sort of the commercial experience of renting a hotel room. And so they had this clear vision from the very beginning of what they wanted the emotional connection of the host and guest to be, in a way that someone who might have worked in the hotel business for 20 years, who knew how to run a really efficient hotel, but their view was, the clean room, great food, but a professional as opposed to a personal connection between the host and guest might not have had. And so there, I think actually being an outsider was a perfect founder market fit. So I think founder market fit is important, but it's not necessarily that you spent a lot of time in that industry. It's more, do you have a concept of what the customers want and need? Should a bootstrap for as long as you can, or is it better to have VCs involved in the early stage? Well, there's trade-offs. So the trade-off is, if you have outside capital, you can raise more money. You can then grow faster if you lose money. And if you end up with a bigger company, if you have a smaller ownership percentage of a bigger company, and your goal is to A, build a successful company, and B, to maximize your wealth, is a smaller ownership of a bigger company better or worse than a bigger ownership of a smaller company? And the answer to that is different for every individual. Of course, if the company fails and you have 100% of it, 100% of zero is zero, so that's not going to work. So you certainly would like to raise venture capital if you think it's the difference between success and failure. And you would like to raise venture capital if your goal is to build a successful company, and that's more, and you think if the company succeeds, you'll be rich, and you're not really concerned about being a billionaire. You think if you can make $10 million, that's plenty good for you, for at least for your first company, because you could always, if you make 10 million from your first company, you'll be very fundable for your second company. Maybe you can make 100 million for your second company. So sometimes first founders say, what I'd like to do is keep enough ownership that I can be rich, meaning $10 million. But if I don't make $1 billion, that's fine. I just want to maximize the chance of my first company succeeding. That will be a great outcome for me. And then I want to find my best venture capital partners who will help that succeed. And if they get rich too, I'm fine with that. That's probably the most common approach. The alternative approach is John Oringer at Shutterstock, who founded Shutterstock. He was the first employee. He wrote the code. He went out, he took 100,000 images. He put his images online. He had no outside money. He made profits from the first year. And today he owns almost 50% of a $3 billion company, and he never raised outside venture capital. So if he had raised venture capital, he would have had much lower ownership. So there's a trade-off, and there are great examples of successes on both ways. What's my opinion about founders without an academic degree? I'm thinking about dropping out to focus on building the company. Well, if you're Bill Gates or Mark Zuckerberg, it doesn't really matter that you dropped out, you didn't have a degree. If you start a company and you drop out and it fails and you're 30 years old and all you've done is had a failed company, you don't have a degree, you might want to think about what that means. I'm not sure having the degree matters when you're 30. I think to some extent, I think actually getting in, for instance, if you got into Stanford and you dropped out of Stanford, the fact you got into Stanford means you're good enough, and that's actually probably good enough for a lot of people rather than the fact you graduated from Stanford. It's sort of the credential. But one way to think about it is, I don't think, I know that Mark Zuckerberg did not drop out of Harvard and then start Facebook. He started Facebook while he was at Harvard, and he only dropped out after Facebook was enormously successful. And I'm not sure about Bill Gates, but I think that was true about Bill Gates too, that they already had built their companies as side projects, and their side projects were working really well and generating revenue, and then they dropped out because they couldn't do both. I think the idea of dropping out first with no revenue and no product market fit to start a company, that's taking a lot more risk, and I'm not sure I'd do that or I advise my children to do that. Well, I think our time is up. I'm really delighted to take all these questions. It's a little odd that I'm getting these questions in text, so I can't see you, but feel free to reach out to me at jeff@bvp.com. I would very much appreciate a chance to get to know you better and to follow up and help with any questions you have. Thank you very much.